What's going on, FS? I just wanted to make a short video to get the week started off. Do a small weekly recap of what happened last week and some things to look out for going into next week. So I've put together 3 slides. This will be somewhat of a sneak peek into Tuesday's macro discussion, but we'll talk about this and then talk about some potential ideas to look out for next week. So to get started, this last week was really characterized by a massive short squeeze. You were seeing some of the worst companies, in terms of financials and potential growth outlook and negative earnings, actually showing some of the biggest strength and largest moves within the market. So what that tells me is that while the major indices were up overall, and some of the large mega cap tech was up as well, including Apple and Amazon, some of your biggest returns for the week were coming from the garbage sector of the market. And per Goldman Sachs, this week's degrossing, aka short covering, was the second largest within the past 5 years, which I found to be very interesting. But it also, that's pretty much confirmed by what we were seeing in a lot of the price action from this week. Go back and look at charts like Carvana, AMC, BYD, Wayfair. There's a million in this basket. I can't think of all of them off the top of my head, but you look at that and you can see that story being told. Now, this poses the question to me, now does this mean that most of the market participants have taken off their shorts, i.e. protection, even with the worst recession risk continuing to rise and heading into the weakest part of the season historically, that being September and October? So I find that interesting as a setup where if people are collapsing their short books, thinking that the bottom's in, thinking that the market narrative shifting, thinking now's the time to get long, and say they do get longer. We'll look at the positioning data on Tuesday during the macro discussion. I don't have access to that right now. But say the consensus is no longer net short, well, that would be a very interesting shift heading into what could be a very seasonally weak part of the year. So what this means is I'm going to be looking for anything that is at the top end of the range with an IVOL discount if possible. Now, I think I've shared this link before, and I can share it again. Just reply to this video and ask if you would like for me to share it again. But this is where I've been calculating my own implied volatility discounts and premiums. So apart from I usually get this data from Hedgeye, but I found this website, and if I want to look at names that they're not covering in their research, I've basically confirmed that a lot of the data that comes from this site is fairly accurate based on some of the names that they cover, by comparing something like Google here, which is showing a 38% implied volatility discount. That is very similar to what's on their sheet of research that they updated last Friday. So looking at this, if I were to look at Google's IVOL discount, I would take the current implied volatility, now divide that by the realized volatility and subtract 1, and that's how I got a negative 38% implied volatility discount. But going back to the slides here, so Google is a good name to look for based on that premise, but it also has as a factor exposure, it has very low short interest. This is something that everyone owns. So if you want to be short something to reduce your risk in a squeeze like this, make sure you're Googling, and I'll let you do your own research on this, but you just Google I'll just do it in front of you. Google short interest. Market beat is usually the one I look at right here. And if you look, it's got 0.36% short interest. But something like BYND, which I've mentioned here in the slides, right? So the high short interest names are the ones that have gone down the most, and a lot of these stocks have high short interest for good reason. But that also presents the risk that you could get caught in a short squeeze on, as you can see over the past 2 weeks. Some of these names have gone up maybe 100% off the lows, and that doesn't change anything about the fundamentals of the company. Something like BYND is potentially a zero, right? But being short high short interest right now is, as a factor exposure, it has been performing the best. It goes down the most, but it is subject to more risk. So here I'll show you something like BYND. This stock has a short interest of about 38%. So that's a very significant difference from, say, Google. Wayfair is also one with very high short interest, but potential balance sheet issues. So if you look at something like BYND, this is just my research I'll rattle off to you. I like this stock short. It's just hard because you can't short. It's too expensive to borrow shares to short, so you have to use options, and the options premium is really expensive. So yeah, that means you have to be really correct with your timing. But look, they reported earnings and the stock went up 21% on Friday. Nothing's changed about the fundamental structure of this company. You just had a lot of shorts. Like, look, you can literally see from this candle that this is where it opened and it just went straight up the entire day. Nothing changed. Look at that. Straight from the open. There was no like dip or anything. It just immediately covered and you saw that spike. So this is just one to keep on your radar. Just doing a little bit of back of the napkin fundamental research on this stock. This is a company that has currently $454 million in cash. It's got debt of $1.1 billion and a free cash flow of negative 90. It has a negative gross margin. So this company is losing money like crazy right now. And basically, if they keep losing money at this rate, then they have 5 quarters of cash left to burn, which is an immediate issue. So that means they either have to issue more stock or equity to raise money, which is dilutive to the existing shares, and that will cause the stock to go down, or they have to take on more debt. But that's going to be difficult in a tight credit market like this when a bank looks at the financials and they're like, oh shit, this company is not in a good spot with their balance sheet. So that's just one name to keep an eye out on. There's some analysts that think that it has less than 4 quarters of cash burn left, but I'm just doing a very basic assumption of if all were equal and they weren't going to lose more money or lose less money. So potentially 5 quarters of cash left on this company. Wayfair is another one that has balance sheet issues that this company could get cut in half again based on a lot of the research by hedge eye analyst Brian McGough. You can follow him on Twitter, but he's been talking about how the fundamental outlook of this company hasn't changed, and they're also in a tight bind in their balance sheet. I briefly looked over the financials myself, and this company is the profits are slowing significantly on a year-over-year basis. However, they're experiencing a rising cost burden as well. So this is one to keep on your radar as well. But again, high short interest here. So going back to these slides, one of your best shorts you could have been this last week, and one that I've kept on, has been the soybean short. But one thing to think about in terms of as the macro environment shifts a bit more, the inverse correlation between gold and oil. So you could think about taking a long position in gold and hedging that, being short commodities or oil or soy. I like soy more than other commodities because in terms of short positioning, it's less short than the other commodities. So that's why I've been staying short soy, because something like corn and wheat, which are very similar commodities, have much higher short interest. So I've been liking the soy short a lot more than both of those. So that's been one I've kept on. I'm going to be looking to add some gold as we get some more favorable dips. But on a week over week basis, gold was actually up against the CRB index 4.2% in terms of alpha, but 0.5% week over week versus CRB index being up CRB index being down minus 3.7%, oil being down almost 10%, and soy being down almost 4.5%. So that's just something I wanted to put on your radar. Here's a chart of gold. You got an interesting structure right here that it came down and tested and held. I don't know if this is going to play out. I drew this a long time ago. This long-term cup and handle. But yeah, no, I mean, this is something that I will be watching out for, is seeing if we can get a buying opportunity on gold. In terms of the 3-month momentum, it's still below. So that's kind of what I'm looking for, watching this line kind of come falling down and seeing if gold can kind of make some support here. But I'll be looking to add. I still have a position that I started somewhere like right in here. And I mean, I did sell a lot of, I think I told you guys I was long gold at the beginning of the year. I did sell a lot, probably around this level, and then bought more here thinking this level would hold. Didn't hold. So now I'm not losing a lot of money on 5 to 7% on gold, so I'm just going to hold it, what I got. It's a minimum position, and I'm going to look to add to it. So this is the last thing I want to talk about before I get into a couple other ideas, is this chart that Hedgeye produced, which is a comparison between the S&P 500 in 2008 and oil. So by the time oil peaked during 2008, the S&P 500 had already crashed, and following that peak, they both continued to crash together until the market trough. So what this tells me is that it's almost a demand issue, and as demand falls enough, then that's felt in the S&P and also felt with the oil demand. That goes back to the long short commodities play, where gold has been picking up some momentum as inflation expectations are falling. Remember, gold is very sensitive to interest rates, and in contrast to popular belief, it is not an inflation hedge. It is actually a deflationary, and it's deflationary and trades more like a currency. So gold performs a lot better when inflation is actually declining and interest rates are declining as well. So as oil continues to fall, that dramatically impacts future inflation expectations, which means that that's a positive case for gold. Hence the long short call out here for gold and commodities. As oil goes lower and other commodities, that should be more beneficial for the gold thesis. So these are a couple things to keep on your radar. If I went a little fast, just go back and rewatch some of this, but make sure you take some notes on this, because I might have spit out a lot of information here. But I'll go over a couple names that I'm looking at coming into the week. So one of them is ARGT. So this is Argentina. They have 3 straight quad threes according to the Hedgeye model, which is in what I've been putting in the slides. That's scenario 3, which is stagflation. This country also has, I think, significant. They have a reasonable amount of credit risk, but here's Argentina, up one of the largest in terms of ETFs and country ETFs. It was up some of the most out of everything in terms of ETFs last week, and so now it's approaching the top end of its range, and this is one to potentially keep an eye on to be short. If taking a short position on this, you need to remember that this stock, Melly, comprises about 26% of that ETF, so it's going to trade very similarly to this ETF. This is a growth stock. earnings report wasn't bad, and it squeezed up big time on this. This was up 16, but basically this was up huge this week. In terms of a weekly basis, the stock was up 26%. Yeah, so that's why you see an 8.7% increase in ARGT for the week. But they're going to trade very similarly, and so you kind of have to track both if looking to take this trade. But I don't see why this can't make lower lows from here. So definitely keep that on your radar. Dash is another one. You had this earnings report. It initially opened up way up here, maybe like up 15% on the earnings, and actually ended up closing down on the day. So that was a good sign for me. And this is a name that is basically, I mean, they're losing money, and hence the negative earnings on a cumulative basis since the stock went public. They've grown their revenue by 531 million and posted an EBIT loss of 898 million. And even if you add back the stock-based compensation expense, this company is one of those that hands out stock like crazy. They're still posting a loss from the inception of their IPO. So this is one that's currently above my trend line, but I'm going to look for it to not be able to hold that trend. So I like this one, and I sent around a document that has some notes that I took over the weekend. There's some ideas in there. Let's see, what else do I got? American Express, this is one to keep an eye on. I'm still waiting for the implied volatility. The financial sector, for some reason, has had an implied volatility premium, so I'm waiting for that to decline. But American Express is one that is widely owned, or not widely owned, but the company is widely used by a lot of people in the upper middle class. The upper middle class is going to be facing a lot of pressure with just inflation and the wealth effect taking hold, as a lot of people in that class are going to start losing unrealized or realized gains on a lot of their investments. So that's one to keep on your radar. I like probably my favorite right now is HYG or JNK. I'm looking for the momentum to stop here. So far they haven't broken down, but once it's kind of hit this area, it started to lose its momentum. So I own the September puts on this, so I still have plenty of time to be right on this trade. But this is one that if I do get some more green days next week, I'm gonna add to, because this blue line, the 3-month momentum, is gonna start trending down lower and lower. By the end of the week, it'll finish up somewhere right in here. Actually, right here. Currently, right where it stopped going up initially. So that's one that I'm going to be keeping an eye on, and it's probably one of my favorite trades, because the implied and realized volatility on these is much lower than a lot of these other assets in the market. So you have a lot more room for error on something like trading high yield credit. But think about from a perspective of what I've talked about with the risk that a lot of these companies have of negative profits and in increasing cost structures, is the margins are going to continue to get tighter, and companies that are losing money, their debt becomes a lot more riskier. So the high yield ETF continues to be a good short in my mind. XLF, this is the financials index. So a large component of this is American Express, but I don't think you can go wrong with financials right now. Once you lose that eyeball premium, the yield curve is significantly inverted, continues to make cycle lows, and this is basically saying banks borrow at short-term rates and lend at long-term rates, and so their margin on that is negative despite their increase in interest income with the higher rates. So that's just something to keep in mind. It also filled this gap, so this is one that I'll be looking at. EFNL is Finland. Keep an eye on this. See if we get the top end of the range. Same with Sweden. Sweden has an inverted yield curve. AMD is riskier. And it actually, let's see, AMD is riskier just, because it's not a bad company, but I like maybe being short this just because it's heavily retail owned. And a lot of people have been just buying short dated call options, expecting this to go up forever. So this is one that I like thinking about short because if we get this next leg down, it has favorable downside. EWY, this one's one that's close to the top end of the range. This is South Korea. South Korea continues to tighten and has a negative macro outlook. This is one that Brian McGough actually cited FIGS on the Hedgeye retail team, basically saying their management team cited that the macro outlook is challenging, and said the macro outlook is challenging and said that their guidance could come down towards the low end of their range. However, they're maintaining their current forecast. He believes that they should have guided down. So this is one that's currently above what I consider the trend, but I'm looking for it not to be able to hold. XLC is the communication sector. This is one that has just been absolutely awful and has had an eyeball discount. Google and Facebook make up like 40% of this ETF, so you're basically trading with those. So just kind of keep that in mind. But this is another one you can add to your short list. So this is one that Brian McGough also doesn't like, the Hedgeye retail analyst. It's holding below its trend right now. It has earnings coming up next week, so that's a potential risk to get squeezed. This is a name that has high short interest, so just keep that in mind. But I like continuing to look at this one short. BBY is another retail name that their team has cited, so look for this one at the top end of the range. I don't know anything about that one fundamentally. CC is one that has been cited by their industrials analyst, the Hedgeye industrials analyst. This is one that it's a chemical company and same with CF. Both are in the fertilizer industry, and as you see energy prices roll over, especially natural gas, you're going to continue to see the prices of fertilizer roll over as well. So this is a potential play on that area of inflation rolling over, right? Because we're going to start entering a point where inflation's going to start rolling over and decelerating. At that point, you want to be short some of the components that were heavily and highly inflated. So the fertilizer component was one of them. So this is one to keep on your radar. CC. SE is a growth company that has heavy exposure to Asia. They posted they're still posting losses, and we'll see. They have earnings coming up on the 16th, so there is some earnings risk here. However, it's at the top end of its range against this level of resistance, and we'll see if it holds. But this is I wanted to just put this out on your radar. But I think that's about all I have for these names that I'm looking at. But I haven't made any significant moves last week, especially because the market kept squeezing. I'm not really sure when that's going to end. But we're getting to a point. We have a CPI report this next week, which is a potential catalyst. And also, we're going to have the QT start to double in less than 4 weeks. So there is some potential catalyst here on the horizon to be on the lookout for. I'm not going to speculate on what the market's going to react to the CPI print, but we'll just have to wait and see. Last thing is that keep watching the dollar. This is basically the truth teller of the market. It's continued to maintain its structure, and we'll see where it goes from here. But just continue riding the long dollar until it breaks. And before I get off, we'll look at some currency pairs. So This was Australian dollar's been it came up and failed at trend last week. So that's an interesting one to keep an eye on. Canadian dollar, also interesting. This one again is heavily impacted by the commodities trade. So as oil and commodities go down more, this currency should be impacted. So keep an eye on this one. I think they also raised rates 100 basis points themselves last week, but their economy is also in a weak position, and they also have a very heavy debt burden. So raising rates like that could put pressure on them. So keep an eye on them. Obviously, keep an eye on the euro and the pound. The euro has been trading in this tight range, and so we'll see what happens. But the euro's one to keep in mind. If it is at the top end of the range, it's worth taking a shot at. I've preferred kind of taking a look more at the Canadian dollar and the Australian dollar, just because the euro and the pound have higher short interest. So you could also consider shorting francs. So right now, this is my trend for the USD franc pair, and we're now at a point where you could maybe come up to test this previous lower high. So this is one that I'm keeping an eye on because it's now recaptured its trend. This trend line is going to start moving up here over the next several days and next week. So keep an eye on the franc because this is one that I was short via XFF. I was short the franc here, made money here, took myself out of the trade, and now if I get maybe some positive price action next week, then maybe I'll enter it short again. But we'll just have to look and see. So that's all I got, and please reach out if you have any questions, and looking forward to talking to you on the macro chat. Bye.